The financial system was not designed to teach you how it works. It was designed for you to participate in it without actually ever fully understanding it. Banks profit all the time when debt is misunderstood, which is what they're literally banking on. Markets reward patience, but the industry literally sells urgency. And the people who are the most vulnerable are the people who have just simply never been truly taught financial literacy and the simple fundamentals of how money actually works. I'm Andrew, I've been a financial planner for 13 years, and today this video is gonna change that. What follows is a structured level foundation in financial literacy, built not for passive consumption, but for practical application. Pay close attention, take notes, because this is the beginning of a completely different relationship with money. Here's a number worth sitting on. More than half of working adults in developed economies can't answer 3 basic financial literacy questions on interest rates, inflation, and investment diversification. These are not obscure concepts. They are the mechanics that literally govern every mortgage, every retirement account, really every financial decision made over a lifetime. The consequence of that gap, however, is not abstract. It shows up in data every single decade. Households with high income but low financial literacy consistently underperform households with moderate income and high financial literacy in net worth, retirement preparedness, and long-term financial security. The variable that matters most is not how much money is earned every year, it's how well is money understood. The following 5 principles are the foundation of that understanding. Master these, and moving forward, every more advanced financial literacy topics will start to seem easier and easier to understand and apply. Principle number 1, the wealth equation. Wealth is not earned, wealth is retained. Let that sink in. And this distinction is one of the most important concepts in personal finance, and the one that's most consistently overlooked for some reason. Wealth is not a function of income, it's a function of the gap between income and how much you're actually spending, multiplied by time. A household that takes home $80,000 a year but spending $65,000 a year is building wealth, whereas a household that brings home $300,000 a year but spending $295,000 a year is not. The financial term that we refer to that has to do with this is lifestyle inflation, and it affects most people. A lot of high income earners are impacted by this. The automatic and oftentimes unconscious expansion of spending over time as income grows. Lifestyle inflation is one of the most common reasons why people in their 50s, even though they've been high income earners for a long time, have insufficient savings, they're not ready for retirement. And this isn't due to bad luck or horrible investment decisions. It's typically due to the quiet, steady erosion of the wealth gap. And so the first discipline of financial literacy is protecting that gap, deliberately and without compromise. Without the gap, there's nothing to invest, no money to pay down debt, nothing to protect, nothing to grow. Principle number 2, assets, liabilities, and the cash flow test. And most importantly, not everything called an asset is actually an asset. The clearest framework in personal finance applies what we call the cash flow test. An asset generates positive cash flow. A rental property with positive monthly income, a dividend-paying stock portfolio, a business with operating profits, a bond with regular coupon payments, any holding that produces more cash than its cost to maintain. A liability generates negative cash flow, a vehicle loan, a revolving credit card balance. Any financial obligation that requires recurring outflow of money without producing offsetting income is a liability. So applying that framework to the most widely held financial asset in most households, a primary residence, financed with a mortgage, serviced with property taxes, maintained with ongoing repair costs, fails the cash flow test technically. Now trust me, I'm a big proponent of real estate, so this does not mean that real estate is a poor investment or a poor decision, because many factors beyond cash flow influence that choice. But what it does demand is clarity, because a financial plan built on misclassified assets are going to continuously underperform for you. The strategic objective is completely systematic. Acquire cash flowing assets and reduce cash consuming liabilities. Widen the gap between the two until the assets generate enough income to fund the lifestyle entirely. That is financial independence. It's not a number, a structural outcome. Principle number 3, the compounding imperative, which means that time in the market is a non-recoverable resource. You will never get back time. Compound growth is not a strategy. It's literally a fundamental mathematical law. And it works precisely the same way whether the account's worth $10,000 or $10 million. And the principle is very straightforward. $10,000 invested earning 8% annual rate of return for 30 years, left entirely untouched, equals a little over $100,000. $100,627 to be exact. without a single additional contribution. The input was $10,000, the output was over $100,000. The mechanism was time, which means the most damaging financial decision available to any investor is not a bad stock pick, it's delay or procrastination. Every year of delay does not only reduce the final balance by 1 year's worth of growth, but it removes the compounding effect of every year subsequent that year is built upon. And this is why the sequence of financial decisions matters as much as the decisions themselves. Emergency reserves first, specifically to prevent liquidating investments under stress or duress. Tax advantage accounts second, to reduce drag on growth. And then open investment accounts third, to build scalable long-term wealth. In that sequence, in that order, without exception. Principle number 4, use debt as a tool, not a condition. It is so important to understand that debt itself is not inherently destructive, but misaligned debt is. The distinction that separates financially sophisticated from financially vulnerable ones is not whether or not debt is used, it's how. We want to be looking at productive debt. Debt that is used specifically to acquire an asset that generates more cash flow than the cost of the debt. It's very simple. For example, a mortgage on an income-producing property, or a business loan with a documented return on investment, or leverage that amplifies an asset, versus consumptive debt. This is debt used to fund an expenditure. Credit card balances on lifestyle purchases, financing on depreciating goods, and any obligation where the borrowed amount funds consumption rather than production. A $7,000 credit card with a 22% interest rate, serviced with minimum payments only, requires more than a decade to eliminate. And it generates over $9,000 in interest charges. So the total cost of that $7,000 in expenses exceeds over $16,000. It was the price of misaligned debt. The discipline of financial literacy requires treating consumptive debt as a financial emergency, not a convenience. If you can't afford to pay for it in cash, you should not be spending the money on it. And eliminate it with the same urgency that you would apply to any other financial threat in your life. And principle number 5, behavior is the variable that decides everything. And understanding that financial outcomes are behavioral outcomes. Every principle covered so far is technically simple. The math is accessible. The logic is sound. The frameworks realistically are not complicated. And yet, financial failure across every income level, in every market condition, in every demographic, remains one of the most persistent patterns in modern economic life. The reason is not ignorance of the principles, it is the inability to consistently apply them under emotional pressure. When portfolios decline, the instinct is to sell. Even though we all know buy low, sell high, everybody does the opposite. When income rises, the instinct is to spend. When the future feels distant, the instinct is to delay. None of these instincts are irrational. I want to mention that and acknowledge that because they are deeply human, but they are systematically incompatible with long-term wealth accumulation. Financial planning literacy is unambiguous on this point. The investor's own behavior is consistently the largest drag on investment return, exceeding fees, taxes, and market volatility altogether. The solution is not discipline in that moment. The solution is architecture. Automate savings before spending decisions occur. Set investment contributions to run without manual intervention. Define the financial plan in advance and let the structure enforce the behavior. The goal is to make the right financial decision the default, not the exception. So listen, these are the 5 principles, the complete foundation of financial literacy. Remember, wealth is retained, it's not earned. And at all costs, protect that gap between income and expenses. And remember, assets produce cash flow, liabilities consume it. Know the difference precisely. And remember, compounding is time dependent and delay is one of the most expensive financial decisions available. Don't forget that debt is a tool, not all debt is bad, and misaligned debt is a liability masquerading as convenience. And most importantly, behavior is the variable. Build systems that enforce the right decisions automatically. And also, this is just the beginning, and it's genuinely important. But remember, financial education, even at this level, does not replace a financial plan. Understanding compounding growth is not the same as knowing the precise allocation, account structure, and contribution rate required to reach a specific retirement target date at a specific age with specific amounts of income and a specific tax profile. Those answers literally require analysis, and analysis requires somebody who does this professionally. Those who build real wealth, durable wealth across economic cycles, do not rely on general knowledge alone. They work with financial planners who build strategies specific to their situation and who make sure that every financial decision is aligned with the long-term plan. I'm Andrew. I've been a financial planner for 13 years. Please subscribe.